Hey, welcome guys, to my channel that is Auction Market RS. So this is my channel handle and your host is Rohit Sawant. So the people who have viewed my previous videos, they might have know me. Okay, so let me introduce myself. So this is Auction Market RS and this channel is hosted by Rohit Sawant. So basically I have around 10 plus years of IT experience plus 8 plus years of share market experience. Okay. So I got a couple of feedbacks from the viewers saying that they want to understand some basics about the auction market, like what exactly is auction. So this is a very new in terms of the price action in Indian market. But when you talk about US market, it's been in use like more than a decade. People are aware of this particular auction market theory. But compared to India, the auction name is something compared with the property dealer or any bank deals or a gold deal, or someone is trying to mortgage the thing and then they auction. So there is a miscommunication happening about this particular concept, auction market theory. Okay, so the basic fundamental remains the same about the auctioning. So where we auction the gold or we auction the property, okay, based on the bid and the ask price. The same thing happens in the share market as well, guys. Okay, so let me move to the next slide. Okay, so what we are going to learn today. So today is about the life cycle of the auction market and what exactly is a failed auction. So there might be a failed auction also, right, in the market, and there might be successful auction also. What is the basic difference between a failing auction is getting failed, okay, and how an auction is getting successful? We will understand that. Okay, so what exactly moves the market? So as per my understanding, I have gone through various theories, taken tremendous trainings from most of the people. I don't want to take their names because they want to keep the name secret. So what I came across in the market is like, you do anything but nothing is going to work unless and until you understand at what particular price, how many buyers we have and how many sellers we have. That's when we get some confirmed decision whether we need to go in a CE call or we need to go in a PE call. Okay. So just looking at the normal price action or candlesticks pattern, it's a 50-50 kind of and stuff. Okay. Where you're depending totally on the luck. Like there are various theories that we are not going to discuss it today, but we are focusing on the auction market. What exactly moves the market is like, according to me, it's an auction market only. Okay. We have a bid, we have a ask. If that bid and ask matches that particular contract get closed. Okay, let's move to the next slide, guys. So yeah, here's the basic example. You have a Nifty buyer and we have a Nifty seller. So the Nifty buyer is trying to quote a price 24,300.05, but we have a seller 24,300.25. The contract is in decimals, but in market the decimals also count a lot. The price fluctuates, there is a price gap due to technical glitches, so that plays a very important role. So you have a fair value. So now we can see in that particular box the price has come somewhere around 24,300.15, and the seller price has also agreed to that particular price 24,300.15, and we see a match over there and that particular contract gets closed. So this is the basic of auctioning. The buyer and the seller should be satisfied at the end of the day. If nobody is trying to bid fairly, then there are, enough chances that particular bid might get failed. So in the upcoming slides, we will try to understand how the bid get fails, how the auction gets successful. Okay. So what is a failed and a successful auction? So for a price, okay, consider the Nifty is running for 24,300, and if we have more than expected buyers or sellers at the top or bottom, then this might lead to a failed auction. Okay. So what exactly this means? At particular price point, who is going to win the race? Okay. At the end, there will be only one buyer or one seller who is going to, win the race. If we have multiple buyers and multiple sellers, bidding for the same price, that auction will definitely fail. So here in that example, in the failed auction image, you can just see it. We have multiple positions, getting filled up, but nobody is satisfied. The buyer is also not satisfied, the seller is also not satisfied. Why? Because that particular price is not going up or not coming down. It is getting filled with multiple peoples. If multiple people are trying to, you know accumulate that particular price, so nobody is going to win over there. So that particular auction will fail, and it will go in either of the directions. As you can see here in the image, multiple times the attempt is happening, to make a successful auction. So there should be only one winner or one loser. There cannot be multiple winner and multiple losers. Okay. So if there are multiple winners and multiple losers, then it comes under a failed auction category. So in the image, you can clearly observe how the price action behaves. So this is called a failed auction. Okay. How about successful auction? In successful auction, you don't see too many buyers or sellers. There will be only one seller or one buyer at the top or at the bottom. So this we can consider as a wick. Okay. So there will be a long wick at the top or at the bottom. So that, you know for that particular zone, we have only one winner. So we called it as successful auction. Okay. So how about a fair value gap? So for successful auction to happen, the bid should start fairly. It should be within that particular range. So this is a market profile, and the market profiles comes up with the, by default, 70% fair value area. So the blue color area, whatever you are seeing, it's a fair value area. Okay. So the price will be moving within that particular fair value. If it tries to cross that particular point, it will fail, and it will again come back in that fair value zone. So this, easily you can get in any of the trading platform market profile. So whenever you're trying to trade in any market, just make sure you have market profile enabled in your trading charting platform, so that you understand what is that particular fair value area, what you're trying to bid, what you're trying for ask. Okay, so I'll just explain is price that attracts most trader between the market hours. Buyers and sellers aggressively participate for that particular volume nodes. Okay, so the green color what you see in market profile and the purple color what you see, it's a volume node. Okay, balancing and resulting the trade under that tight range on a higher volume. It's a tight range, guys. So that particular price is not going to, go out aggressively or go down aggressively. It will be trading between that particular range. Okay, that is called a fair value gap. Okay, let's move ahead to the next slide. So we need to understand the life cycle of auction market. What happens in the auction market? Okay, so basically it will be a supply and demand, whatever we call it as a support and resistance. It is also called as supply and demand, the high volume tight range area. Okay. So supply should match the demand, and the demand should match the supply. This is the first phase of the auction market. Then the second phase comes is the imbalance state. Okay. Imbalance state acts like either of the side. The supply is greater than demand or the demand is greater than supply. It can be either of the thing. Once the imbalance phase is gone, okay, once the aggression phase, in the imbalance phase, we also call it the aggression phase, where price will move out of our particular volume range that we already discussed in the previous videos. Okay, so I request you guys to go back and verify what exactly is supply demand, what exactly is imbalance, what exactly is balance. Okay, if you're if you're getting confused here, I request you to go back and watch my previous videos. If you want, I can also provide the link in the description after this session. Okay, so after the imbalance session, we called something called as the fresh buyer and the fresh sellers which enters into the market. So that is called a discovery phase. So that particular fresh buyers and fresh sellers will try to move the direction in one direction. So that's the reason we call them a fresh buyers and fresh sellers. But the main point here is to understand that those fresh buyers and fresh sellers might be a retail seller as well, because he don't know how the market moves and how to identify the retail sellers or retail buyers. Easily we can identify with the help of lower volumes. So in the cluster chart, you get a confirmation about the new buyers or the new sellers who are entering into the market to define a particular trend, but that particular trend will be having a very low volume profile. So that can be catched easily in the auction market. But if you try to catch this particular concept in some other price action, normal candlesticks pattern, it is very difficult. It is fairly a 50-50 chance where you take a risk and that particular trade might go in opposite direction. But when you compare with the auction market theory and a cluster chart concept, you can easily try to identify the fresh buyer and seller with the low volume profile. You won't get enough volumes for that particular fresh buyers and sellers. Take an example, the price action for that particular uh, price, it is telling we have something called as 15K buyers. But when you look at that particular candle, it will be green. But when you look at the delta, it is negative. So that's where we will try to isolate with the help of volume whether we need to enter in that particular trade or we should not enter into that trade. Okay, hope you guys are with me. So let me take you to the next slide. Okay, how price moves in the fair value and what exactly is the right place to enter into the trade. So whenever a price moves from a fair value, okay, each and every support and resistance is a fair value. Unless and until the price is, within that support and resistance, we call it as a fair value. Once it crosses that particular fair value and enters into the other market profile volume node, it goes into the imbalance trade. So how to trade the imbalance trade? We have to wait for a pullback. As you can see in this example, we are waiting for the pullback, that is called a retracement. In the retracement, we see couple of candle patterns. Okay, so that should be in our favor. Okay, this is first point. Second point, we need to look at the delta. Is delta in our favor or no? We get a double confirmation over there. Once we get a double confirmation, then only we enter into the trade. But we have to, wait for the retracement when the price is moving from one value area to another value area. Value area is nothing but one support area, okay, which is getting broke and becoming resistance, or resistance is getting broke and it is becoming support. Okay, okay, guys. I think you have understood this concept. So let me move to the next slide. Okay, these are particular examples for the recent Nifty charts. In the previous day chart, you can see we have plotted a market profile. The green color is the resistance, the purple is the support, and the red color line, what you see in the previous day, it is the high volume node. Okay, so coming to the present day chart, at the right hand side, you can see like the price started from previous day volume node, okay, and it is trying to break the previous day fair value area. Once it broke that particular fair value area, it is coming for an pullback, okay. So once it come back to that pullback, we have to understand the price action. We need to understand that particular delta. The delta should be always positive. Then only we will enter into the trade. We get a double confirmation. We look at the trade and wait for our profit target for 1 is to 2. Okay. 1% is your stop loss and 2% is your target. Okay. I'll show you a couple of more examples here. Okay. Here also is the best example. Previous day, we have a fair value area. Okay, the green color is the support, purple color is the resistance, and the higher volume area is the red color line what we see. Okay, so as we can understand, the present day open a gap down market. Okay, gap down, it traded down, but in the second half immediately a bullish candle broke the previous day fair value area or the volume node, and you can see how the price went up, without even retracement, it went up. Okay, so this is a two different concept when you have to wait for a pullback and in which situation you should not wait for a pullback. Okay, there are defined conditions. In the upcoming videos I will try to explain you more on this, but for a basic understanding, like the viewers reached out to me personally and saying that they want to understand some basic concepts. Okay, don't try to make the video like too many technical things. Just make the videos simple. So I'll try to make rest of the points in the upcoming videos, but as of now you try to understand the zones first, how the zones are behaving. Okay, let me move to the next slide. Here also you can try to see previous day we have a fair value area, the green color and the purple color, and the red color is the volume zone. Okay, and the next day, that the present day, you can see the price moved between that particular range. It never crossed that particular range. So whenever the price crosses the previous volume node or the previous fair value area, what exactly we called it? It is called as imbalance state. In imbalance state, we either go for a pullback entry or we go for a no pullback entry. So there are various conditions when you have to wait for a pullback and when you should not enter for a pullback. Okay. So we can, try to understand this with some more concepts. Okay. So I'll try to move this particular uh, slides to the live chart. Please allow me some time, guys. Okay. So we are on a Go charting trading platform. Okay. So here I will try to make, okay, I'll just try to clear all this stuff, delete all the lines. I'll just plot the market profile for you. Okay. So this was the recent example which I've, plotted in the presentation. This was the fair value area, and this was the fair value area, which, crossed very aggressively. Yeah, even this was the example. Okay, so here is the best example what we can see. So we will plot a line over here. In the next day, you can see market went up, gave a failed breakup, again came back. Okay, So this is a valid pullback. So your exact entry comes over here. Wait for a pullback, guys. Okay. I'll show you a couple of more examples as well. So this is a fair value area where in the next day it did not cross this particular fair value area. It was, ranging between this area itself. It never crossed. Okay, here is another example. You can see for 25th of July. Okay, this was the fair value area. Okay, we plotted this particular line. Okay, market went up, it came back for a pullback, and it came down from this particular level. Thank you guys for watching this video. Please do share, subscribe, and comment on this particular video. If you have any doubts, I'll try to clear in the next upcoming videos. Thanks for your time. Bye bye.